Hi, this is Ryan Cook of Cook & Company, Certified Public Accountants. We're a CPA firm in Clinton, Missouri that focuses on helping clients solve problems and live an intentional life. Now, as you are already aware, there's been some significant tax legislation passed towards the end of December of 2017. This was some of the most sweeping tax legislation we've seen in over 30 years. It was originally designed to impact corporations. It was more focused on corporate tax reform, but there were some provisions, and there are some provisions that impact individuals as well. So this video is going to focus on the changes to businesses, whether it's an S Corp, a C Corp, a partnership, even a sole proprietorship, which includes a Schedule F farmer, and even potentially a 4835 taxpayer, which is farm rental. So there are changes to the individual and corporate tax rates. For instance, the top individual tax rate is dropping from 39.6% down to 37% starting in January 1st, 2018. And items that received significant coverage by the media is a reduction in the corporate tax rate. So corporate tax rate is being reduced significantly down to 21%. Now for many corporations, at least corporations around here in the Midwest, it was not uncommon for us to meet with the client and plan and help them experience a corporate tax rate as low as 15%. So for some smaller, closely held C corporations, you may actually see a tax increase as a result of the tax reform, because your rate may be increasing from 15% up to 21%, which is about a third additional more tax. So it's important to note that. But now that the individual and corporate tax rates have both changed, it's important to analyze your situation to determine, should you remain being taxed as a partnership or an S corporation or sole proprietorship, or should you now elect to be taxed as a subchapter C corporation. Those were all things to analyze with the low corporate tax rate and the change in individual tax rates and brackets. So what are some of the changes to partnerships and S corporations? Well, for years beginning after December 31st, 2017, but before January 1, 2026, there's this new 20% deduction for pass-through income. This is also known as a Section 199A deduction, and allows an individual taxpayer, an estate, or trust. By Section 199A allows an individual taxpayer, estate, or trust a deduction for 20% of the individual's domestic qualified business income from a partnership, S corporation, or sole proprietorship. However, there are several limitations to this deduction. So some questions to ask yourself are, what are these limitations and how will they impact me? Does your business even qualify for the 20% deduction? What constitutes qualified business income? So how is that defined? How does it impact you in your situation? Does passive income, such as rents, qualify for the 20% deduction? If you're in a partnership and your partnership agreement has a provision in there regarding income tax distributions to the partners, does the formula for determining income tax distributions include a provision for this 20% deduction? If not, maybe something to think about and consider, because most partnerships will be making a tax distribution sometime in the first quarter of 2018. So those partnership agreements really need to be reviewed. Another thing that we've been asked by our clients is it worth restructuring to a different type of entity to take advantage of the 20% deduction if it expires after 8 years? So if there's only 8 years of this benefit under current law, is it worth going through all this trouble to restructure your entity and possibly put yourself in a situation that you may not be able to get out of? Some other things to think about are you going to be subject to the new loss limitations for non-corporate taxpayers, whereby any loss must be carried forward to a future year? Certain businesses could be limited in deducting any qualified business interest, so interest you're paying on loans could be limited under the new tax laws. How is that going to impact you, and how should you restructure your indebtedness and financing to take advantage of these new laws or avoid the pitfalls of these new laws? Some other things to consider are how would the changes in cost recovery, also known as depreciation and amortization, how will those changes affect you? So for instance, for 2017, part of the year has a 50% bonus depreciation. There's also some 100% bonus depreciation There's Section 179 is still available. So which option should you choose? And not just for 17, but even going forward in 2018 and beyond. When should you buy equipment and depreciate it? How should you depreciate it? Which of these provisions should you take advantage of? You don't know till you run the numbers or talk to your CPA. How do the expanded Section 179 rules impact your decisions in buying qualifying assets and placing them in service? There are also some significant changes to the cost recovery of real property. So the new law eliminates really a pretty lucrative 15-year recovery period for qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property. So with those provisions gone, how are you going to depreciate any improvements that you're anticipating making on your or through your business? So a couple other final thoughts regarding this tax reform is like-kind exchange rules and the changes to those. So now like-kind exchange rules only apply to real property and only to real property that's not held for sale. So how does this impact your trade or business? For example, if you're a farmer and you trade in a combine for another combine, well, the like-kind exchange rules under the current reading of the code effective for 2018 do not allow for like-kind exchange of the two combines. So the trade-in value of the combine you're trading in would constitute a sale, and then you have the cost of a new combine to capitalize and then make your depreciation elections on. Lastly, and this is pretty significant too, we live in a fairly small community here in mid-Missouri, and we have some very active Rotary clubs, optimist clubs, things of the such. And one of the major changes under the Tax Cuts and Jobs Act is the elimination of the deduction for entertainment, amusement, and recreation. So now your dues that you're paying to your optimist club, your Rotary club, etc. are no longer deductible starting in 2018. So as you can see, there are a lot of opportunities within the new law. There's also a lot of pitfalls as well. And from a CPA's perspective, it's really difficult to give general advice. So to ensure that you take advantage of the opportunities of this new law and avoid the pitfalls, because you can plan around a lot of these things, not all of them, but a lot of them. So to take advantage of the opportunities and plan around the pitfalls, we encourage you to reach out to us here at Cook & Company or your CPA to determine how the new tax law is going to specifically impact you and your situation. We thank you for the time today and hope you enjoyed this video.